In this session, we will cover cash generating units or CGUs in relation to goodwill impairment. What is a cash generating unit or CGU? It's defined as the smallest identifiable group of assets that generates cash inflows which are largely independent of the cash inflows from other assets or groups of assets. It's a mouthful. What does it actually mean? Let's use the furniture and fittings of a retail store as an example. This furniture and fittings couldn't generate cash flows on its own. You would need a store, inventory, and staff. That is, you would need some level of working capital to start generating cash inflows. And you may even need a brand name to attract customers to the store, for example, the Walmart brand. This group of assets is a CGU. Similarly, goodwill on its own cannot generate cash flows. And as you know, we need cash flows to calculate the recoverable amount, particularly to calculate VIU. Therefore, we combine goodwill with other assets such as fixed assets, intangible assets, net working capital, so your inventories, receivables, and payables, and sometimes corporate assets such as the head office. And all of this combined together form a CGU, which as per its definition is a group of assets that generate cash inflows. And then we can test for goodwill impairment. Let's use Walmart, a supermarket retailer in the US, as an example on how to use CGUs when performing goodwill impairment assessment. Let's assume over the past 5 years, Walmart acquires 15 supermarket retailers in 3 different states. So New York, California, and say DC. And Walmart acquires all of these 15 supermarkets through M&A transactions, and each transaction creates some goodwill. Now, each of these stores would meet the definition of CGU, as each store would be a combination of assets that generate cash flows. So the question is, since there are 15 CGUs, does Walmart need to prepare 15 goodwill impairment assessments each year? No. According to IAS 36, the test level for the goodwill impairment test should be based on the lowest level on which top management monitors goodwill. No director in the board monitors goodwill and reviews performance of single stores, but rather on a reportable segment. So the board may monitor on a per region basis, so for example, per city or per state. Therefore, in our Walmart example, the CGUs need to be grouped together based on the lowest level of how top management monitor it, that is, say stores per state, hence 3 groups, and therefore 3 goodwill impairment assessments. The level on which goodwill is tested, however, must not be higher than the operating segment as reported in the financial statements. So for example, if Walmart reports store performance per state on its financial statements, one cannot go and perform goodwill impairment testing on a country CGU basis.